More money making. Today I want to talk about the very first question you may have about investing. Why should I invest? If you have some money left over each month, even just a small amount, I'll explain why investing is a good choice for this money. See my video on budgeting for a discussion of some easy ways to free up some cash. As always, if you like what you're watching, please destroy the like and subscribe buttons and notification bell for the YouTube algorithm. Investments such as stocks and bonds offer above-inflation returns on your money over the medium to long term, and so can help it grow and increase your spending power over time. Inflation is the rate that prices increase year on year, where the government target is 2% annually. Over the last century, the FTSE 100, which is an index of the 100 largest companies on the London Stock Exchange, has returned around 5% above inflation on average. So essentially, investments in this index grew faster than the cost of living. Savings accounts, on the other hand, usually offer below-inflation returns, so even though your money may be growing in nominal terms, it's actually losing spending power over time once you take into account inflation. This will become clear with an example. Let's say you have £1,000 in a savings account paying 1%. So after 1 year, you'll have £1,010. But if inflation is 2%, this means that things that cost £1,000 last year now cost on average £1,020. So even though your money grew by £10, you actually lost £10 in spending power that year. It's sometimes possible to match or beat inflation on smaller amounts, but for larger amounts, investing is the better choice in the medium to long term. Savings accounts do have their uses in the short term though. Investment returns can be volatile, and in extreme cases, individual years have had up to 45% positive and negative returns. If you lose your job and need to cover your day-to-day expenses, or you get unexpected medical or car bills, and so on, you can use money from your savings accounts rather than having to sell your investments when they may have gone down. We call this money sat in savings accounts an emergency fund, and experts typically recommend this to be 3 to 6 months of living expenses. If you start investing at a young age, you benefit from the 8th wonder of the world, compounding. At the end of year 1, your returns are just from your initial investments, but then each year after that, you will achieve returns on the returns of the previous year, and so on. This will become clear with an example. If you invest £1,000 and you achieve a 5% return each year, then by the start of year 2, you'll have made £50 in returns, so you'll have £1,050 in total. By the start of year 3, you'll have made £52.50 in returns, so you'll have £1,102.50 in total. And by the start of year 4, you'll have made £55.13 in returns, so you'll have £1,157.63 in total. Your returns increase exponentially, which means they go up by more and more each year you're invested. Think of this as a snowball rolling down the hill, getting bigger and bigger with each revolution. You don't have to be the next Warren Buffett to get started with investing. If you follow what's called a passive investing strategy, it can be as simple as investing in a single fund called a multi-asset fund. They're very low cost and give good returns through what's called diversification, which is investing in a broad set of companies, industries, and countries. You achieve close to average market return and actually beat most active investors who try to beat the market by picking certain stocks over others. Some examples of multi-asset funds are Vanguard Life Strategy, HSBC Global Strategy Portfolio, and BlackRock Consensus Funds. See my videos on asset classes for a discussion of the different things you can invest in. Investments can be used towards major long-term financial goals, such as buying a home, starting a business, or putting your children through university, and they're also a good option when saving for retirement. In fact, if you have a workplace pension, you're already investing through that, and you can also benefit from employer contributions. It's very important to maximize employer contributions, since it's essentially free money. For example, if you're contributing 5% and your employer is contributing 3%, which is the legal minimum, then that's an automatic 60% return on your investment without taking into account actual investment returns. See my video on pensions for a discussion of workplace pensions. There are various tax benefits with investing. Paying into a pension comes from your pre-tax salary, so you save on any income tax you would have paid. which is 20% if you're a basic rate taxpayer, 40% if you're a higher rate taxpayer, or 45% if you're an additional rate taxpayer. See my video on pensions contributions and tax for a discussion of exactly how this works. You also don't pay any tax on capital gains or dividends. A capital gain is the difference between the buy and sell price of an investment. Dividends are a share of company profits while you hold an investment. A big advantage of investing is that it could allow you to retire earlier than the state pension age. This is currently 66, but is rising to 68 for people born after April 1978. You can currently access your workplace pension from age 55, but this will rise to 57 in 2028, which equates to roughly 10 years before the state pension age. Investing outside a pension could enable you to retire even earlier than this. In the UK, you can save into what's called a stocks and shares ISA. As of 2021, you can invest up to £20,000 per year from your post-tax income. Like for pensions, you don't pay any tax on capital gains or dividends. Unlike pensions though, you can access the money at any time, so you can use it to generate income to fund early retirement. See my video on pensions and the 4% rule for a discussion of how this works and how much you might need in total. Even outside of pensions and stocks and shares ISAs, there are tax allowances available for investments. If you have more than £20,000 to invest per year, you can invest in a general investment account, or GIA, and earn up to £2,000 in dividends and £12,000 in capital gains per year tax-free. One final thing to note is that investing is an important part of business creation and expansion, which provides new jobs and products. You can also choose to invest in things you really believe in and have a passion for, such as green energy. So as you can see, investing is a powerful way of building wealth in the medium to long term compared to savings accounts. See my video on when you should invest for a discussion of the reasons why you should start as soon as possible. Don't just take my word for it though. Here are some famous investor quotes. The historical data support one conclusion with unusual force. To invest with success, you must be a long-term investor. John Bogle. Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Albert Einstein. If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.